Hi everyone, this is the first panel of the day out of the two. We will have three guests from great VCs in the panel. Please welcome Joe Bond from ProFounders Capital. Maciej Noga from Pracuj Ventures. And we should have Magda Posluszny from Speed Invest any second now. Someone is trying to find her. Okay. So in the meantime, when Magda is joining, maybe we can start with a very brief introduction. So could you introduce yourself and the fund?
Hello, that's working, okay. Hi everyone, I'm Joe. I work at ProFounders Capital. I've been there 3 years, work as a principal. We're a seed stage fund based in London. We're currently investing out of our second fund, which is a 60 million euro fund. We're a little bit different in that the money comes from individuals that have been successful technology founders themselves. Includes one of the founders of Active Hotels, which became Booking.com. One of the founders of Top Table, which is a marketplace that got bought by OpenTable. We really like investing in marketplaces. We were the first investor in Get Your Guide, which is the biggest marketplace for city tours and attractions based in Berlin. We also invested in One Fine Stay, which got bought by Accor Hotels a few years ago. And we're co-investors with Market One and Speed Invest in PackHelp as well.
Thanks.
My name is Maciej Noga, and firstly, I'm co-founder of Grupa Pracuj, like 20 years ago, which is still one of the biggest marketplaces in Poland. Currently, I'm running the corporate VC which is evergreen, but we are putting our money into this vehicle. We focus mainly on HR tech and ed tech, which is our area of expertise. And we are a seed stage, running from 150k euro to 1 million. And secondly, I am also angel investor, so I invest in a lot of Polish companies.
Hi everyone, a pleasure to be here. My name is Magda and I work for Speed Invest, which is a 200 million seed stage fund headquartered in Vienna. We also have offices in Berlin, Munich, London, where I'm based, and also San Francisco, where we have our operational partners that help our portfolio companies expand into the US. Typically, we invest at seed stage, and what that means, the average check size for us is around 1 million euro or pounds. These days, the valuation is pretty much the same. And yes, we invest across Europe and also in the US. Some of our portfolio companies, as previously mentioned, PackHelp, Tier Mobility, WeFox, Tide, a lot of fintechs. In terms of the sectors, we invest in fintech, industry tech, deep tech, and marketplaces, which I'm focusing on.
Cool. So the subject of the panel is what investors are looking for in early stage marketplaces. And definitely when looking at investment opportunities, there's a lot of factors investors look at. But if you would have to name just like 2 or maximum 3 of the key most important things you look for in seed stage opportunities, what would they be?
So for us, I think the first thing is kind of a checkbox of, is this a big enough opportunity? I'd encourage all entrepreneurs to really understand how VCs think, the fund economics of a VC. Particularly for a seed stage VC, about half of your investments are going to fail. So the remaining ones need to make up for those losses and deliver good returns. So we're always asking ourselves the question, firstly, can this be a big opportunity? So that's both, is the market big enough and is the level of disruption big? And that's kind of the factors that Martin was talking about earlier around what is the value creation of the marketplace, the actual advantage of being there and connecting supply and demand. And then I say the other factors for us obviously is the quality of the founding team, and really what I mean there is kind of people that are obsessed with delivering a really good customer experience. I think in the early stages, it's less about the growth GMV and the growth metrics. It's more about what have you been focusing on to really make sure the marketplace is working and customers are really delighted by the experience.
Yes, so for me, the potential of the market as well, like we only look for the big opportunities nowadays. And the second thing, the founders, of course, we are looking for great teams. But the third thing, which is very specific for I would say, like our branch, is like the mission. Yeah, we try to invest in the companies that are changing or impacting our environment.
Okay, so I absolutely agree with Maciej and Joe. When it comes to marketplace companies specifically, I would encourage you to have a look in your goodie bags where you can find our very comprehensive answer to that question with a marketplace scorecard. If I was to name a few chosen ones, I would say first one, a very fundamental one, what is actually the value proposition and why there is a need for a marketplace to exist. So we would look for very fundamental things like what is the market dynamics that will enable a marketplace to thrive? Is the supply side very fragmented? Is the market intransparent? If yes, you scored the point. What will the marketplace bring to the market? Is it going to enhance the market? Is it going to provide benefits to both sides of the platforms? If yes, then you also scored a point. Secondly, what I would mention is also unit economics. So does this business make sense? What is your margin on that business and how quickly do you recover CAC? Also, what is the velocity of the transactions? Is it a one-off purchase at the marketplace? If yes, then how quickly do you recover that cost of acquisition? And then thirdly, I would say obviously potential for network effects. Although as we know, it's pretty hard to spot that at the early stage, but we look for the how do you design, how do you build your business, and is there actually an intrinsic potential for that company to exhibit network effect in the future?
Great. Then the next thing I wanted to discuss a bit with you guys is regarding the founders, because obviously at the early stage, they are very important. So what specifically are you looking for in the founding teams when you evaluate the projects?
So for us, we have a strong preference for multiple founders for the reasons that I think we mentioned earlier. And I think I'd come back to that word obsession. For us, it's really about people that are very passionate about what they're doing and passionate about the customer experience and how they're innovating. If I take Johannes Reck, who's the founder of Get Your Guide, in the early days, he was so obsessed with delivering a really amazing experience to the customer. He was actually running city tours himself in Zurich, going on them, interviewing customers, making sure they kind of understood how they're using the app, how they're enjoying the experience. And it was that kind of deep obsession on the actual product and the value of the marketplace and getting it working in one location that allowed him to then, replicate that playbook elsewhere and grow it to a really big business.
Yeah, so I will build on the top of this because we actually also have a strong preference for teams, and especially when even there is like one founder, we encourage them to find co-founders because like that in the progress of the project you actually need and people are there smiling because that I find the founder to co-founder there. Yes, we are also looking for passionate guys, but we are also looking for the track record of such a people. So what was your path? Like what was, you are founder now, but what was your story before? And I think this execution is very important for us. That's not only like a good idea, potential and passion, but also the execution.
Okay, so let me be a little bit more controversial here. So actually, I would say backing a single founder is not really a deal breaker for us. We actually made an investment this month into a very solo single founder. What is actually important, so I absolutely agree with what Maciek said. Ability to execute and that you prove that. So either it can be proven through your previous track record, but it can also be proven by your existing traction. So how quickly do you deliver? How quickly do you execute? What is your capital efficiency? How much are you able to build with your limited resources? So that's one. Secondly, what I would say is super important, and also sometimes investors not really pay attention to that, but not everyone, this is really important. But actually, what is your motivation? And interestingly, one of our partners always asked, what is your personal motivation for doing what you're doing? And quite often the answer is, oh, the market is very interesting. It's growing at 15% CAGR. And to be honest, is that actually, we all know how difficult that journey is. And is this reason that CAGR will be still that important to you further down the line? Will we still be able to sustain that motivation? So I would say that is actually a really important factor for us when assessing the founders.
Cool. Another aspect I want to touch upon is the metrics. Obviously, for a marketplace, you can measure the supply, the demand, the transactions. So there might be a lot of different metrics and numbers involved. But which are the most important for you when assessing an opportunity? Just to name like 2 or maximum 3.
So I'd say the metrics will be different for each type of business, but at our stage, the ones we'll be most focused on is that value creation of the marketplace of the product. So that could be customer reviews, frequency of review, repeat rate of people coming back because they love the exchange so much. I say these are the kind of metrics we would focus on most, over and above the unit economics or the pace of growth, because if you get that first step right, then there are kind of tried and tested playbooks for growth, or you can make assumptions around what the unit economics could be in the future and get comfortable with that, but you can't really fake the first part.
Yeah, so for us, we are a little bit different because we are mostly investing in SaaS and SaaS-enabled marketplaces. So in terms of SaaS, of course, we are looking for the MRR and churn and all CAC and LTV, which is quite standard. Actually, what is specific, we would like to see the 2-3 times yearly growth for the seed stage, which is important because then we know that the team can execute. And in terms of the valuation, then when at the early stage, it's really hard to determine the valuation. We would like to see that growth to actually see the round A around 2 or 3 times more valuable.
So for us, speaking about marketplaces, I would say one of the key criteria is actually retention for us. So what we would always we would ask you for cohorts. We would like to see how does your retention, how does engagement on the platform changes over time. We would like to see that it is improving over time, that you know why, that you have control over that metric. And secondly, of course, growth is hard to argue with. So if you have 20, 30, 40% month-on-month growth, there is little that we can say that there's not interesting. So definitely that is the second thing. And the third also, your gross but also net revenues, when we're speaking about marketplaces, is it also really important that you know how are you going to monetize and that you keep your take rate healthy. Otherwise, so the difference is like if your take rate is only 1 or 2%, then your GMV will have to be much, much, much larger than for a marketplace that is only that has a take rate which is more healthy of around 20%. So yeah, these are key for me.
Great. So another topic which is quite important in the talks with the founders is obviously the valuation. And at the seed stage, the talks about the valuation are much more difficult because not always you have the numbers which you can base the valuation on. But let's start maybe with the case that there is some solid structure. So there are some numbers. The GMV is like 50, 100K monthly or 200K monthly. So there's already something. And how do you approach the valuation then? And then later we can switch on to the topic when the numbers are not that important or not that visible yet.
So I'd say in the early stage, valuation is definitely more of an art than a science. And I'd say even if there was kind of GMV of 100K monthly, that wouldn't be the main kind of factor, any kind of multiple of GMV or anything like that, because it depends much more on the other factors which we talked about before, which is the founding team, the size of the opportunity, I guess the validation against different kind of parts of the business model. Do people love the product? Are people coming back? That kind of thing. Typically, in the early stage, you find dilution of about 20 to 30% in each round, which is fairly standard. And I guess the response to that could be, well, let's just raise more money because then there'll be a higher valuation, which sometimes is true. But you then need to, I guess, have a credible plan for how you're going to spend that money, and you've got to justify it in that valuation in the market. I guess my advice to founders would be the best way to get a higher valuation is to create a competitive round and create leverage, either through being cash flow positive, which is probably quite difficult in the early days, but more likely by having multiple VCs competitively bidding for your company.
Yes, I think we have a similar approach, but I will try to quantify it because when we see the growth, like at least 10% a month, and then we see that the company is growing 2-3 times a year, and then we see that GMV, that annual GMV is there. So we then think that 1 to 2 times that GMV could be like a good opportunity. Of course, also like factors like how long is the runway, for example, like we are, and when the money will end and what would be valuation also is very important. So we try to put all the puzzles together, and this 1 to 2 times GMV it's our number sometimes.
Sure. So when approaching valuation, I would say like there are 2 relatively simple approaches. So one, what you look into is how much are you raising and what is the average dilution that you should expect. With what we're saying, the average dilution between like seed and Series A would be 20%. And then secondly, just comparable. So ask your friends in the ecosystem, what are their valuation? Look at the databases. There are quite a lot of sources about that. And I think that's basically what venture capitalists also use. They compare the growth and what they're seeing in the market to other companies, and then they determine if that's affordable or that it's too expensive. And also something to have in mind is it's great to shoot for a higher valuation, but that can be also a double-edged sword. And I've seen examples of both companies failing because they overshot with the valuation in the previous round, especially when you're an enterprise company and your sales cycles are much longer, then you also should factor that in. And obviously make sure that you're raising enough money to get you onto the next stage and avoid kind of the bridge rounds.
Yeah, one more topic on this, which you covered a bit already. What's your expectation on the valuation uptick for the next round? Like, what is the sort of base case scenario you would like to see of the valuation raising in the next round? because that also like gives you some numbers, how much you should raise, because the next rounds are more and more sort of numbers focused, right?
Yes, I mean, we did the exercise of looking at portfolio companies that raised the next round. It was two to three times uptick was the kind of range. The best companies getting a 3 times uptick. So I think as a VC, we will be thinking about, yes, when the metrics, when valuation is going to be more based on metrics at the next round, kind of working back from that, thinking, okay, well, what valuation can we be paying now in order to get that uptick? So that will be a factor, and that's a reason why you shouldn't raise it too high a valuation.
Yes, I already said that we are looking at the same threshold, but I would say the reality for the, like in HR we have enterprise sales, and it's always like long cycles. So we are looking into 2 times. I would like to see 3 times, but it's not the reality.
Yeah, absolutely agree. I mean, we don't really focus on what the next valuation should be. The higher, the better, obviously, for us, for sure, provided that it's reasonable. But what we really look for is growth, and make sure that the company is growing at least 2 times year over year, and that this is broken down into smaller actionable metrics every month, and that's basically it.
Okay, great. Another topic I want to touch upon is return on investment potential. We quite often have dialogues with the founders saying, yeah, this is a great opportunity for you because standalone on the investing in us, you can make 7 times money in like 4 years. And obviously from a standalone perspective, sounds like a very good investment opportunity, but is it the same when looking at the whole fund economics?
So there's also a question that is, what is a good return we aim for? Yeah. I'd say the rule of thumb, which kind of we apply as well, is every investment needs to have the opportunity to return our fund. So the multiple of return, it will depend a bit on kind of what our strategy, what a fund strategy is, as in what the ownership stake you go for initially is, and your ability to follow on in later rounds as well. But so for us, we would try and get a 10 to 15% ownership initially, follow on in the next couple of rounds, but by exit we'd probably have a 5 to 10% ownership. So to return our fund, which is a 60 million fund, it needs to be a kind of half a billion exit or more. So every investment we make, we're thinking about it in a way that how can this be a 500 million plus company? So that's a kind of a benchmark for the level of ambition we need to see, I guess.
Yeah, it's the same for us. Whenever evaluating investment opportunities, we would always ask ourselves the question if that can be a fund returner. And the next question we ask ourselves is always how big this needs to be in order to make sense for us. Then what we think about is that actually doable? So is the market big enough? And we really are meticulous about when we think about the market size, and I would really encourage you to do the same when you're going on a roadshow. And then what size of revenues do we really need to get into? And what are the multiples on those revenues? And of course, bunch of factors that needs to be factored in as expected dilution over time. There's some more capital intense businesses. And how much the acquirers used to pay in the past for companies at a similar stage or similar sector.
Okay. Yeah, sorry.
Yeah, because for us it's like we are open-ended fund. So I would say like if we were a normal VC, I would say like for the fund maker it's like a rule of thumb. But for us it's more that we are looking at the exit, because these are like really enterprise-specific businesses to whom we can sell it and how long does it take to actually, to go there. So it's like totally different.
Okay. Last question I have for you guys is around deal breakers. So assuming that the startup fits your criteria in terms of geography, stage, industry, business model, and so on, what are the most common deal breakers you see in transactions, and can they be worked around somehow?
I'd say the kind of trust is very important. Obviously, it's kind of a cliche. You've all heard it all before, but you're entering into a long relationship with the startup, with the founders. So it's incredibly important you have that trust, and it's someone that you're willing and happy to work with, and you see a collaborative relationship going forward. So I think in some cases we've been very excited about a deal, and then it's broken down just because there was a bit of dishonesty in what was revealed, or we didn't have the kind of rapport and on either side kind of a willingness to work together going forward. So I think that relationship is super important and is probably not talked about as much.
Yes, I would say that for sure we are not looking into cap tables because, I would be very controversial. And for me, this especially European style that, when the founders are really diluted, so they are not motivated, is very stupid. And I really don't understand it because mostly we are looking for the people who are motivated and have passion, and the money comes at the second round. So I would like to say that anybody has a screw up cap table, come to us really, because, and for sure we are not looking at this, but we are looking for founders, for that passion, for the motivation. And sometimes there is even a great business, and we see that people deliver what they promise. But then we imagine if, for example, it's a global business, how they are sitting in front of the C round. Do they still be trustworthy, and can they actually, rise another rounds? So for us, the team and the long-term relationship could be a deal breaker.
Yeah, so I think there are still a bunch of there are a couple of approaches how you can fix things. Right? You have influence over so many factors in your business, over who you hire, over the market that you're targeting, how you're positioning your business. I think there are various ways you can really, really make that happen given what you have. What are really the deal breakers is definitely what Joe mentioned. So whenever someone is dishonest, trying not to be super transparent, or trying to hide something. And secondly, because we're in Poland, I cannot agree more. Unfortunately, this is what we're seeing quite often in companies coming from CE, that the cap tables are just not fundable. And again, how to approach it. So it might happen that you currently have an angel, or you're part of a venture builder that took 50%, 60% of your business. And provided that they gave you something for that stake, you can still make sure that you fix that situation before you go on a roadshow. What we typically need to see after seed series is that the founding team, including the ESOP, has over 50% of ownership. And unfortunately, this is not the case in many startups in Poland. I don't know why, but really make sure you negotiate well. If you haven't, make sure you speak with those investors, and make sure you also take people on board who do understand that dynamics.
Great, thanks a lot. Please give a warm round of applause for our panelists. We have 10 minutes for questions from the audience. Anybody?
Hi, Adam from Utro Medical. I love that you're relying on metrics when making a decision on investment, but I'm trying to understand when it comes to churn and lifetime value. Are you just looking at the high level, or going into activation rate, engagement, resurrection, intensity, frequency, or dormancy of the users? Are you trying to understand the underlying reasons for the metrics? Yes.
Yes, of course. It's we are looking into metrics and try to understand the business, what is value creation and value capture. And then, of course, sometimes in the seed stage, like we are approaching the not, I would say, ultimate business model. So we see what is the potential to actually fix it with the different, approach. So we try to understand, and of course, there is a bunch of metrics which people use for, like this kind of comparable. But in the end, we are looking for the, that the idea is when there is a value creation is the value capture, I would say.
Yes, of course. So we are also very metrics driven, even at the pre-seed stage, pre-seed stage. But what is really important that one, which metrics are you focusing on? You do track them, and I do really mean that. There is not really a single set of golden criteria, at least not for marketplace, because every business is so different, and there's so many different ways of how you can monetize that marketplace. So it's a bit different to SaaS, but yes, we would break down both the engagement, the retention, and really try to understand what can we achieve and how we're gonna get there. So it's not really sometimes not that important if something is not really there yet. It is important that you know what, you know why, and you have a plan to fix that.
The only thing I'd say on churn is I think it kind of depends what stage you're at. We obviously look at churn, but in the early stages it can be a bit of a it could be a bit of a kind of red herring in terms of a metric, because in some cases you've signed up a bunch of customers and they actually haven't had enough time yet to churn because they're on 3 months, 6 months contracts. Or in the case of a consumer business, you could be still trying to find product market fit, and you've gone and tested a new marketing channel, got a bunch of customers that it just wasn't right for, and they've churned, and that kind of makes your metrics look bad. But what we care about a lot more actually is the customers that are using it, how engaged they are, how frequently they're using it, how much they're coming back. Because if you found something that really has product market fit for one set of customers, you can still build a good business.
Hi, I have 2 questions, possibly related. So one is, what's your #1 investment thesis? And the second one, what's the #1 factor that differentiates you from other investors?
So it's a good question. So in our case, I guess there's 2 things. I'll answer the second part first. Like I said, the money in our fund comes from a group of successful entrepreneurs and founders, which we think is a bit of a point of difference. The reality is they're very busy people. They're not spending 3 days a week supporting our companies, but they can kind of shortcut tasks in certain ways, whether that's an introduction to someone high up in another company, or whether that's really having a day spending a workshop on viral marketing, which is Michael Birch, the founder of Bebo, did that to one of our companies. It was very helpful. So that's one element, that kind of network of investors. And the other thing is we're quite measured in our pace of investments. We only do about 4 to 5 new investments a year. So we try and be very supportive of the companies in the early stages, particularly trying to get them to the Series A stage. And obviously that's knowledge of how to successfully raise a Series A is something that we will naturally be better at than a lot of the startups. And then our thesis, I mean, we're quite generalist in terms of the type of opportunities we look at. But I'd say our focus at the moment is on very big opportunities where there's a right to win in Europe. So we've been doing a lot of investment in fintech businesses, in prop tech businesses, in these kind of old sectors that have a strong amount of talent from European cities.
In terms of Pracuj Ventures, we have 20 years very deep domain knowledge about HR. That's why we are focusing here on Poland. And what we do is like a really smart money, but we are taking the companies from point A to B, open the door, because we know all the HR teams and directors. So we are really giving added value, and always one of the criterion of the investment is how we can help you, because we really believe that money is only one factor, and the second factor to create that value is our help. And in terms of the angel investment, I would say that I'm focusing on the teams that usually have a track record in the previous investments. So, you know, it's already like we started to invest from 2009, so it's already like the second batch of the founders. So we really like it.
Yes, in terms of our investment thesis, as mentioned, I'm part of the Speedinvest X team, which focuses exclusively on companies that have the potential to achieve network effects in the future. So part of that are marketplaces. We look for companies with big markets that have the potential to obtain a significant market share. There, in terms of how we differ, that's a very good question. So actually, we're significantly different. One big difference being that we are basically 60 people in the team, which is probably on average 10 times more than an average VC fund at seed stage would have. And from that, around 40 people are in the investment team and 20 people are on our operational side. So we have 2 operational teams, Speedinvest Heroes, that help our portfolio companies with hiring, and Speedinvest Pirates that help our portfolio companies with growth. Also, as mentioned, we have an office in the US with operational partners that can work there on the ground for you and help you get onto that market, help to get to the clients that you want. We also help quite a lot with the fundraise because we actually have a lot of human resources to help you hands-on. So also the investment team would sometimes work as HR managers trying to help with hiring. We also have an operational partner in next team who focuses on product. So there's quite a lot of people who can actually help.
Okay. Any more questions?
Thank you. Warm intro versus cold approach. How much should a founder invest in trying to reach you through the recommendation?
Yes, I'd say we look at every single company that knocks at our door, regardless if it comes through the website with just a cold pitch deck or comes from our most valuable, most renowned VC friend. What helps is definitely the warm intro for someone from the ecosystem, so either the portfolio company or another investor in the space. I would say it's probably not that hard, right? Even like when you go on an event like this, you can talk to someone and say, okay, is this in your investment remit? If not, can you help and provide me with one introduction? A lot of investors are really building their businesses on the networks that they have, so they also have to give back, which we always try to do. So even if we don't invest in a startup, I also like to take time and if I can, help with another intro. So definitely helps.
For us, it's definitely almost the same, because we are very specific. Sometimes we have to really dig very deep. And then there are like projects in the very early stage, somewhere in the software houses. So for us, of course, warm is very good, but we are not actually, I would say like 10-15% it's coming from the recommendation, and the rest we are actually digging.
So I'd say actually it doesn't matter. As long as in your cold outreach, you're concise in what it is you're doing, attaching a pitch deck that gets to the point quickly and tells a good story in no more than 10 slides. We will always read those emails, and if it piques our interest, well, regardless, we'll get back to you, but if it piques our interest, we'll set up a meeting. Actually, in some ways, a warm intro might make us obliged to take a meeting even if we don't want to, so that could be a waste of your time. So actually, I'd say, for us in any case, a cold intro is just as valuable. A cold reach out.
Yeah, well, I would say like the cold approach can be really effective, but you really have to put a lot of effort into it and really make sure you're targeting relevant people, because that is one of the very common mistakes, that the startups are either at a different stage or doing something very different. So really make sure you target right people and really make sure your deck, when you're approaching people cold, is really super crisp and really sparks that interest and makes people intrigued.
Okay, so huge applause for. Sorry, we are out of time.